Welcome to our latest in a series of ongoing webinars related to the real estate sector. My name is Greg Riedman, President of the Chamber. Really happy to have the group of people that have chosen to spend the last week of July with us this morning. We have more than 100 people registered for this event, and really a lot of key people who are both in the real estate sector and in retail or office space who've registered. So we're very excited about this panel and this program. And looking forward to the conversation. A couple of housekeeping things before we get started. My name is Greg Riedman. I'm president of the Chamber. This real estate series, and we've done a lot of webinars over the course of the during the shutdown, is once again sponsored by Direct Federal, and we appreciate their support, as well as all of you for being members of the Chamber who are and supporting the Chamber over time. And the Real Estate Committee that has put these together, including Elizabeth Holmes, who's chair of our events committee, will be your moderator this morning. Usual stuff that you probably all know now. There's a chat box, so you can have your own conversation while this is going on, and we will be working in as many questions as we can at the end, so please use the Q&A as well to do that. One note, we have a panel scheduled in the middle of August that is a follow-up, will be a follow-up of sorts to this. We're gonna bring back a group of retailers that we talked to back in early April maybe, about the experience that they were having during the shutdown. We're gonna bring the same retailers back and have them talk about that. And obviously retail is a big part of the conversation today. So just wanted to mention to keep an eye open for that. And with that, I would like to welcome and thank Elizabeth Holmes from RW Holmes Real Estate, who will moderate this program today. So thank you.
Thanks, Greg. Hi, everyone. Thank you so much for joining us this morning. As Greg said, I'm Elizabeth Holmes. I'll be the moderator today. We're really excited as a real estate committee to bring this event to all of you. In our prep call with all the panelists, we're hearing it a lot that their clients, other companies who have been reaching out to them, are asking a lot of questions about what's coming up in the real estate market, if they have an upcoming lease, if they're growing for new space, what to expect as they're going out and negotiating for new space. So I think we've got a great group of experts here who are going to be able to give us a little bit of guidance and help you navigate that process, especially when everything else is so tumultuous. So without further ado, I'll just give you a quick outline of today's event, introduce the panelists, and we'll get going. So we got about 40 minutes or so of prepared questions that our panelists will go through, and then we'll leave ourselves hopefully about 15 minutes for any questions from the audience. So please feel free to use the Q&A box, as Greg mentioned, and we'll try to get to as many questions as we can. So without further ado, jump over to the panelists. I'll give quick intros and then we'll get started. Starting with Adam Meixner. He is the senior partner and co-founder of 128 CRE. Adam's focus is on office leasing and sales sector within the 128 Central Market and Mass Pike submarket, where he has been assisting tenants and landlords for nearly 20 years. Adam assists with space acquisition or dispositions, lease renegotiations or extensions, and tactical planning. A few of the higher profile assignments that Adam and his team have worked on recently include relocations and or renewals for global companies such as Dun & Bradstreet and B. Riley Financial, as well as offering the BSC in Newton for sale or lease, and the $20 million+ disposition of 233 Needham Street in Newton. Adam is a member of the Needham Council of Economic Advisors, the Newton Needham Chamber of Commerce Real Estate Committee, and the National Association of Industrial Office Properties. Next, we have Adam Convisor. He is the principal and founder of Convisor Property Group. Adam has been in the commercial real estate business since 1995 with a concentration in the retail sector. In 2006, Adam founded the Convisor Property Group and provides the corporate leadership guiding the direction of the company. Adam's team provides retail client services such as retail site selection, store growth and strategic planning, retail trade area analysis, project leasing, market valuation consulting, investment sales, and development services. Some notable Newton Needham area deals include the Little Big Diner, O's Pizza, and Loyal Companion Pet Store. They've also completed over 80 Starbucks deals in New England, worked with George Howell Coffee, Beaver Donuts, Five Guys Burgers, and completed a $40 million portfolio sale in Davis Square. Convisor Property Group is a member of the International Council of Shopping Centers and is the New England member for SiteSource. Adam is also a member of the Needham Chamber of Commerce Real Estate Committee. And then last but not least, on the owner side, we've got Joel Cadis. Joel leads linear retail with his partner Aubrey Canusio. Joel is the Chief Real Estate Officer and serves on the company's board. Joel oversees leasing, asset management, development, and construction. He joined the company at its inception and has worked for 32 years in the commercial real estate industry. His focus has been on retail and office product in the greater Boston region. Before joining Linear, Joel was the Regional Director of Asset Management and Leasing at Wellsford Commercial Properties Trust, Vice President of Portfolio Investments at Atlantic Retail Properties, Asset Manager for Fine Art Company, Portfolio Manager / Assistant Vice President at Citicorp Real Estate in New York. Joel has an MBA degree in finance from the New York University Stern School of Business and a BA in history from Oberlin College. He is a supporter of the Combined Jewish Philanthropies of Boston. So we've got really great experts for everyone today. So jumping into it, we're going to go kind of 3 areas in types of questions. So starting with the market overview, then going into changes that these experts are seeing in the market, and then kind of the owner perspective for any of you companies who are looking for space, kind of what to expect from the owner side. So jumping into it, each of you panelists, can we just get a 1-minute overview of what you're seeing in the current market, what the current landscape is? Maybe Adam Meixner, you can give us a start on the more office side.
Sure. Thanks, Liz, for the great introduction and for the chamber for putting this on. Appreciate it. Really, since June 1st, it's been extremely busy out in the central 128 market. A lot of activity happening in Newton and Needham, and then Waltham up and down 128, really. And I think a lot of that is for 2 reasons. One, a lot of those tenants that had leases that are expiring in the next 6 to 12 months were kicking the can, trying to see how this whole thing plays out. And it was getting to the point where they just couldn't wait much longer. So they realized, once June 1st hit, they really needed to start working on that, whether it be a renewal or a relocation. And then another, reason as to why I think that was happening is people have a better sense as to how their company's functioning and what they need in terms of space, and if they're able to work remotely or not, and changes that need to be made, whether it be mainly, I guess, going from more of an open work environment to hard-walled offices and looking for space that's better suited for the COVID age, I guess, with what we're dealing with right now. So it's been pretty active over the last probably 60 days, call it.
Great. Adam Convisor, on the retail side, what's kind of your 1-minute overview? Oh, sorry, you're on mute.
You're on mute, big guy.
Yeah, sorry about that. Yeah, obviously it's been a challenge with a lot of retailers closed, and we've been dealing with a lot of restructuring and rent concessions. We've seen what was already happening before. We've seen a lot of the trends just being accelerated right now. Rents either going down or stabilizing in a lot of the immediate trade areas outside of Boston. We see just people struggling, trying to figure it out. Obviously right now, PPP and loans are running out, and it'll be interesting to see what happens with regard to growth. We don't see a lot of growth, a lot of people looking for sites. I think it's starting to percolate a little bit. We've just started our blasts on locations, but we see a lot of creativity, people changing store formats, adding takeout windows, redesigning stores, closing to restructure deals, maybe taking this opportunity now to close down, renovate the store, plan for the future, and rewrite a deal, get some TI from the landlord, and sign a longer term lease. But there's a lot to be figured out as far as rent concessions, how you build that back into a deal, how you restructure it, and what the road looks like going forward. But a lot of tenants are just going to struggle trying to figure out how to open. We've seen ghost kitchen on the food side. You see a lot of creativity. Fine dining, not so much, obviously. No bars, but you see a lot of creativity with ghost kitchens and outdoor seating, and municipalities getting very flexible on outdoor seating in the streets and what happens when the weather starts to turn. Who knows? But as far as like boutique fitness, which was a darling the last number of years, how they're going to get back to it will be really interesting. But it's definitely been a struggle. But we are starting to see people looking, planning. But there's a huge thinning of the herd with regard to a lot of restaurants will not open, a lot of retailers will not survive. But it's an opportunity too for digitally native brands, which we can get into in a little bit, to make their push to get brick and mortar. So we'll start to see that. And there are a lot of names that people may not know that you'll start to see grab a lot of brick and mortar.
Great. Thanks, Adam. And then last but not least, Joel.
Morning, everybody. It's a great question. I would say tumultuous would be tumultuous and challenging would be good words to describe what I see in retail. That should not be heard though as depressing and bad. It's just a very tumultuous time. So I think that there's been market emotional shifts as you chronologically move from April through now end of July. I think that really depends upon what time period you're speaking about. In my 32 years, I've never seen so much transition emotionally in such a short period of time. I think in April you had frightened and frozen. That's how I describe the month of April. And then I think you see gradually transitioning to dipping your toe in the water, using some federal money, realizing the world's not going to end, to now where we are actually seeing a material uptick in activity. And I think most people are planning for normalcy from a COVID perspective in the next 18 to 24 months. That's the assumption that people use. So you start to see people starting to make plans, new deals, and real activity. I do agree with Adam Conviser that different sectors are still very much stuck, like sit-down food, white tablecloth kind of stuff, and also boutique fitness where you have densely packed individuals. But we definitely see, example of tenants who might have hoarded cash before are now paying their rent because they're more worried about losing an option contractually because they're in default. That they're more worried about that than they are about hoarding cash. And that's a market shift from, the April frightened, frozen to, wait a minute, we need to preserve our rights because the world will continue, to go on. So I would say in the last 3 months, there's been notable shift to the positive. Needless to say, that assumes that there won't be a second big negative hit on COVID and, the Massachusetts, area. So, but for now, I would say most people are much more positive and activity is definitely materially picking up.
Great. Either Adam Meixner or Adam Conviser, any kind of jumping on Joel's idea, any differences in what you're seeing with your clients from April to now?
I'm sorry, repeat that.
Is there any kind of difference in your clients' thought process from how they were thinking, reacting in April to now how they're thinking?
I mean, I think there's, the nervousness has settled. There's not as much nervousness, right? We know what we're dealing with right now for the most part. And I think people are starting to see a reopening as long as we don't see a resurgence. But a lot of retailers are are thinking about what, beyond the therapeutics, what is going to happen with vaccines. That's going to be the huge thing for a lot of these retailers to really feel comfortable and start making plans. But obviously you see the fast casual segment, and you see the delivery, and you see the takeout windows, and you see drive-throughs becoming more of a relevant thing. And so I think retailers are figuring it out, and they'll make plans going forward to future-proof their formats. But I think that I think people may look at it and say there may be opportunities in the market to make an aggressive real estate deal. We're seeing in some trade areas deals for the next couple of years that are going back to like 1990. So if you have a long-term vision and you want to go grab some real estate, I think there are some deals to be made right now. There are not as many tenants out there looking. There are more vacancies. I mean, if you look, vacancies are going to be on the market longer. At least that's what CoStar is telling you what the trends are going to be. And obviously, there are more vacancies now and more coming. I think there's going to be some great deals to be had. So I think it's an opportunistic time to go make a deal. at least in the short run, where you may be able to get an aggressive deal in the first few years,
Great.
especially with
Adam
Joel.
Meixner.
Joel will do that.
Great. Adam, Mike, is there anything to add on that?
Yeah, I mean, I think the first couple months, call it, March, April, May, where a lot of, businesses trying to stop the bleeding or figure out, what's going on, how they can survive this and try to work out deals with their owners to defer rent and everything. And, like I said, since June 1, it's kind of changed a lot. I think a lot of that has been taken care of. And now people are looking forward and trying to figure out, okay, what do I need from, this day forward to make us successful and make sure that we survive and everything. So I think there's a lot more confidence now in their business and where it's heading compared to a few months ago, really, where there's just so much unknown.
Great. And are any of you seeing a big difference between the downtown Boston market versus the central 128 market?
Yeah, I mean, I can jump in there maybe first. It's a dramatic difference. I think that, like the financial district, let's take the most obvious example is, the retail is very much exists to serve the office population. And a lot of people are not back in their offices yet. So, our office has been closed since, late March. And I don't know that we'll be open. We probably won't be open at least until the fall. So, retailers who are literally geared towards serving that office population, fast casual food, for instance, are not doing well. And so they're open, but their customers aren't there anymore. So it's an interesting point because I was talking to both Adams about this when we prepped, what's temporary and what's permanent, right? That question. So, will all the office workers return en masse, or will a percentage not work in the office as much? Will people work 3 days a week in the office instead of 5, and that's a permanent shift? Or is this a temporary phenomenon where once people can feel safe about going back to the office, then they will do so? I think that downtown Boston, like the financial district, for instance, as opposed to, more heavily residential areas like the Back Bay, I think they're going to face that specific question. They have other physical hurdles, like how do you feel about riding up in an elevator if you've got 2,000 people in an office building and, people typically arrive between 8 and 9 a.m. and the elevator, we've all been in those elevators that are packed. How do you feel about that? I personally would not do that and wouldn't ask our employees to do that. So, you stagger arrival times, et cetera. I mean, you can drill down endlessly on the details of how to make that work. And I think people will have to. But the point I'm making is that I think you're going to see, at least in the interim period, less, I'm guessing now, but I think you're going to see less office workers in their offices in some degree, whether it be people are home 1 day a week or 2 days a week. And I think that's going to be probably, maybe it's higher in the interim and it starts to fill up again long term. But I do think that there's a permanent shift. I think the horse has left the barn to a certain extent on this issue. I think that the great experiment that was not planned and was forced upon all of us has demonstrated to a lot of managerial sort of models that one can successfully and efficiently work not from your office. And so, one wonders whether that will result in ultimately less demand for office space. I'd love to hear Adam's opinion on that. And also, but long term, you wonder whether some retail sales will shift to more residential areas from office areas. So it's just some of the things that we think about in terms of what's permanent and what's temporary.
Great.
Yeah, I mean, our firm doesn't really do downtown Boston, but obviously I read plenty about it and talk with brokers all the time that are focused in the downtown area. And I think this Zoom webinar is great because a lot of people have been asking about, they're reading what the media is putting out there and how awful the market is and everything like that. And downtown Boston has certainly taken a hit in terms of leases being signed, but it's not like there's this giant mass exodus that's really happened because people have leases and they're going for another 3, 5, 7 years and they can't just walk away from them, right? So, I mean, you're seeing a pretty big uptick in terms of sublease space coming on the market. In the last 120 days, there's been about 101 subleases for 1.7 million square feet listed in downtown Boston there versus the suburbs going from Dedham to the Woburn market. We've only seen about 31 spaces for about 930,000 square feet coming on the market. And keep in mind, 100K of that is actually TripAdvisor, which I think was planning on listing that, long before COVID hit and everything. But I mean, we are seeing some downtown tenants coming out, or I shouldn't say we've had the tours yet, but we're starting to get more calls from downtown brokers inquiring about spaces in the burbs. They're keeping their office, downtown, but looking for satellite offices for those executives, let's say, that live out in the burbs, or, employees that are just not comfortable on, as Joel said, riding up the elevators or taking the MBTA in. So they want to be able to offer them options. I mean, yes, it costs them more money to have a second office lease, let's say that's 5 miles west of the city. But if that's what they need to have in order to get their employees to come in and work with each other, then that's what they got to do. And I mean, a lot of it is inquiring about short-term subleases, let's say 2 years, so they're not locked in forever. And hopefully they come up with a vaccine and things go back to relatively back to normal in that period of time.
Awesome. All right. Thank you everyone for the market overview. Moving more into kind of changes that you guys are seeing in the market. And Joel had kind of mentioned this in his overview, but are there any changes caused by COVID that you being more temporary, we're going to see a shift and it will be kind of lasting long term, versus something that's more permanent, or something more temporary that once there's a vaccine, things will go back to the way they were before?
I can go first if you'd like.
Sure.
So yeah, I mean, the last 5 or 7 years, you've seen a lot of companies jamming people into their spaces with cubicles and everything, and obviously that doesn't fly right now, and it's just not safe, frankly. So you're seeing a lot of people, which is why they're out looking for new space instead of just doing a simple, let's say, 2-year renewal, looking for space that has more hard-walled offices to give the employees more of a sense of safety, basically, in coming in to the space. And there are plenty of companies that are allowing their employees to work from home. But if you have to think about it though too, is if you're allowing 50% of your employees work from home, you can't just slash 50% of your space. One, obviously, because you have a lease unless it's expiring, but two, you need to social distance everybody. As I mentioned a minute ago, when everyone was piled on top of each other, you need now 6 feet between everybody. So you're spreading them out, and, sure, you could probably reduce your square footage a little bit, which we're seeing, but not, it's not a straight 50%, slash across the board for everything. And I mean, you're still seeing plenty of activity out in the suburbs here. I haven't really seen much of a change in rent reduction or anything like that, because it's been busy just from, expiring leases and those tenants that are starting to look out in the suburbs. So.
Great.
I think some of the trends, I think that'll continue. I think if more office workers are either doing shifts or there's more activity on that 128 belt. We work a lot of these downtowns, and we've seen a strengthening of the downtown neighborhoods, the communities. I think that's going to be a trend that just, it gets more pronounced, especially if you have, again, these shifts, more people working in the suburbs. I think a lot of people with post-COVID too, at least this is the talk. And I think the residential real estate people will tell you this. There's a huge demand, right, in these immediate bedroom communities on 128. And so I think that is only going to strengthen these downtown central business districts. I think the super regional sites become less important. Obviously, the malls we're not talking so much about the malls, but the malls are going away or changing completely, right? They're morphing into other things, unless it's if it's a B or C mall that's happening. But I think you'll still see a strengthening of the downtowns. We are also seeing, and I think this is a trend that may continue, there are office tenants that are actually looking at retail spaces. There are more and more retail spaces. The rents are coming down a little bit on some of these retail spaces. And I think people don't want to get into an elevator building. At least this is the immediate sort of knee-jerk reaction. But I think I see it as a trend where we may have some more mixed uses on the ground levels, which will add more vibrancy. And I think that's, in general, if there's parking, that's a good thing. Those are some of the strengths I see. I'm really curious to see what happens with the boutique fitness and how it comes back, because that obviously, as we mentioned, has been a darling. I see this as a strengthening of the downtown areas, and I think that'll continue to happen.
Great. Joel?
Yeah, just the topic of permanent versus temporary. I think a lot of COVID has exposed a lot of trends that were already occurring. So I think it's important to segregate what is temporary and what's permanent, but it's also important to identify weaknesses that existed prior that are just being exposed. I almost think they're different categories. So, I've heard multiple panels about sit-down fine dining, and they'll tell you that 2019 was a bad year for them, or a very challenged year, with rising minimum wage and labor costs and food costs, et cetera. So, there's various retailers who probably were on their way down anyway. Pier 1 just declared, or Chapter 11, that was on its way in any event. So that's sort of one phenomenon, which really COVID was just sort of the second of two punches, right? But in terms of temporary and permanent, I do think that behaviors are accelerated or changing. I think that a lot of people who maybe didn't embrace online got a shove in that direction with COVID. So, maybe people who are older who didn't grow up with online options, or maybe people who were too busy to even learn what choices were available, or so I do think that this has been a boost for online in terms of a structural shift in terms of how people behave, because they've had to, and I think it's hard to go back to that for certain types of functions. So it's fascinating to think about what's permanent, what's temporary. I do think, though, that underlying all of this is that many or most people, I think humans have a herd mentality in the sense, in a good way, and that people like to be around people. That's a sort of fundamental nature that we all have, just going down to the absolute basics. So I don't think you're going to have people say, great, I'll never have to work in an office space again, or, it's not an absolute. I think it's more of a degree. And it's going to be fascinating to see how extreme that shift is. But I do think there's a fundamental need for people to be around other people and collaborate and build culture and connect and communicate, et cetera. So.
Great. Adam Meixner, on the office side, are you seeing any changes in the terms that your clients are asking for? You kind of touched on it, but less square footage? Are they looking at different locations? Are there specific lease terms that they're arguing for? Any trends in kind of those requests for tenants?
More so on the renewal side, just seeking shorter terms, because they're not having their landlords do improvements, let's say. So it allows the landlord some more flexibility in the length of term. In terms of a few of the relocations that we've finalized in the last, call it, month or so, and that we're working towards, getting leases signed as well right now, that hasn't been an issue. I mean, both of those, or a couple of them, are 5 years, and then a few of them are even 7 years, because, a lot of that is because they're requiring a lot of offices to be built. So the landlords need more time to amortize the cost over. So, I think eventually, hopefully, we're going to have a cure for this and everything, and a vaccine. So hopefully we won't be dealing with this in 3, 4, 5 years from now. So.
Great. And Adam Convisor, same question for you on the retail side. Are there any trends you're seeing in the terms that tenants are asking for?
I think restaurant tenants especially are starting to really bring their landlords in as partners and understand what, under the hood, what makes up occupancy costs. And I see a trend, at least in the short term, as percentage rent, right? So as you get back and you're reduced on capacity to half your restaurant or half your seats, or your takeout only, that's going to change your model. And I think it goes down the line, right? It's, the landlords have to become involved in these discussions and restructure deals so they don't have a vacancy. So it's either, so I think that's a trend that will continue, that landlords really have to understand, no offense, Joel, but have to understand how these businesses make money, what their pro formas look like, and what is a healthy occupancy cost. So I think, but that's been happening. And I think if there's open lines of communication, I think that you'll start to see some very creative structuring of deals and partnerships. And I've seen it in a couple of other types of not necessarily restaurant deals where there's more of a partnership relationship between the landlord and the tenant and sharing of the upside.
Awesome. That's
I
great
think
to
it's
hear.
a great point, Adam. I think that you have you have to have a recapitalization, if you will, of how certain 2 points. One, I totally agree with Adam that restaurants in particular are going to start looking to share upside, but also share cost, capital costs and downside. And it's more of a, not JV, but more ownership sort of discussions about, qualities of ownership, like upside in capital, because I think the current model for sit down restaurants, at least in the short term, just doesn't make any sense. And I would argue that that didn't make sense in 2019 as well. But that's one example of what's been pushed, over the edge, if you will, the old model. I've had conversations with restaurateurs where I said, are you interested in literally joint ownership? And I think one sort of got a little nervous, but said I would certainly do percentage rent. The other said, no, I would absolutely contemplate that, because it's so expensive to open a restaurant. The failure rate is so high. And so I think Adam's completely right on that point. That's a material shift in terms of, restructuring. So,
Great. Adam Meixner, Doug kind of brought this up earlier, but and you had touched on it as well, but work from home, are you seeing it greatly impacting square footage needs? Are a lot of your clients saying all of our workforce is going to work remote? What are you kind of seeing in that trend?
So I think early on, after, let's say, the first 3 or 4 weeks, employers were feeling a lot more comfortable with having their employees working from home. And, once they figured everything out, and, it seemed to be going pretty well. But it seems as though the tone has changed a little bit on that. There was actually a great article last, I think, Thursday or Friday in the Wall Street Journal talking about a number of companies that are actually, had that feeling early on, and it's totally changed as of late. And they cited reasons that the projects are taking longer because people aren't working in the same office together. Training new employees or even existing employees is significantly more challenging. Hiring and integrating employees are more complicated. People are feeling less connected to one another. And then, additionally, these employers are feeling like the young professionals that have just recently joined their company aren't developing at the same rate as if they were, sitting next to colleagues and absorbing, information on how they handle, certain calls, or how they're, running processes and everything like that. And, most importantly, I think we can all probably, attest to this, but a problem that could usually take an hour to solve is taking all day, because you can't just turn to the person next to you and say, hey, what do we do about this? You're emailing them or, trying to call them, and they may be not in front of their computer or something like that. So taking a lot longer for things to get done. And we're starting to see more people focused on getting everyone back to the office, as opposed to not. And, I mean, if anyone wants that article, I'm happy to share it. But it was, it also talked about a number of global companies like Canon in New York has 11,000 employees at that complex, and they're back up to 50% because they really needed everyone to be back in the office to keep things going. So.
Great. I'd say too, if people are looking for other kind of information, Gensler and Margulies Peruzzi, 2 architects in the area, did some pretty nice surveys that kind of speak to Adam's point of the collaboration and the development of folks is kind of pulling people back into the office once people feel safe and comfortable. So that seems to be a good survey to kind of balance out what we're hearing in the media sometimes of these massive companies telling people to work from home. Adam Convisor, as well as Adam Meixner and Joel, are you seeing any of your clients decide to defer their real estate decisions temporarily if they have, maybe it was an extension that they were planning, or if they don't have immediately upcoming moves, or are they still moving forward with their transactions?
I think it's all over the board. I mean, it really depends on the tenant, but I see there are a lot of tenants that feel like they're going to get through this, and now's a good time. As I said earlier, we have a couple of tenants that have done a remodel right now and asked landlords to contribute tenant improvement allowance into the remodel in exchange for signing a long-term deal, and then also in exchange for, you know, a free rent period or a deferred rent period built back into the deal. So I think tenants and landlords are getting creative that way during this slowdown period where business is off or et cetera. But also, I mean, look, the cost to operate right now is different than it was if you have to space people out or put plexiglass in between, you know, treadmills or, you know, the costs are the costs are the big thing as well. So it's becoming very expensive to operate, but I think that would be my thought.
I agree that it's all over the board. You know, I have several retail. I mean, the reality is that Boston is still a tight market. I mean, if you're referring to Eastern Mass, and the best sites are difficult to find. It takes a lot of work, you know, for the Adams of the world to find, especially in retail though, to find those, you know, prime choice spots. Those are still in short supply. So if you're smart and aggressive and maybe willing to take some risk on the medical issue, you know, you're hunting right now trying to find opportunities. And, you know, in retail, a lot of times the site you want just doesn't exist, period. It's not a pricing issue, it just doesn't exist. So, you know, I've had many conversations with Adam Convisor where he's just hunting and it's just, the sites just don't exist, you know? And so, and a lot of deals still that are happening now are aggressive brokers who are knocking on doors to landlords saying, could you possibly make a space available given COVID? I mean, so again, there's a tightness to the market. So if you're one of those retailers, and I think those are the smart ones who really have their act together, they're hunting right now. Maybe they can pry something loose. I think that's an accurate assessment for for acquiring those A-type locations. So there's that element, and that's, I wouldn't say that's the majority of retailers, but I would say it's a you know, material minority, right? And then you have retailers who they just don't know what's going to happen still, even though they're more optimistic. So their attitude is, yeah, we're going to see what happens. You know what? I'm cautiously optimistic. I'm going to watch my sales volume. I see them creeping up right now. Okay, I think we're going to be okay, but let's see what happens. And then you have retailers who aren't doing well, probably weren't doing well before COVID, who are backing off. So that's a simplistic sort of, you know, three perspectives, but it really is all across the board. I personally have a lot of respect for the retailers who see this as an opportunity to secure and expand their footprint and take advantage. I think that's the smart money, but that takes confidence and you have to be well capitalized and you have to know the local market and you have to have, you know, good brokers like these guys to find those spaces. But that would be my feedback.
Awesome. Any other comments anyone wants to add?
I think a lot of people were, you know, kind of pushing off their decisions, as I mentioned earlier, but realize that they can't really do that much longer. I mean, in some rare cases, we're seeing people just shutting down their office completely and saying, look, we're going 100% virtual until this all settles down. And then we'll, you know, go back and rent an office, which seems a little, you know, crazy. I think they're better off trying to work something out with their current landlord, you know, for a short-term extension and, you know, at a reduced rent. Rather than putting everything into storage and kind of, you know, reinventing the wheel, let's say 6, 12, 18 months from now when things happen. But obviously, you know, they know their business better than we do, but it's a process to, you know, start up an office, never mind just, you know, move it. So.
Great. All right, moving into our last grouping of questions here, kind of the owner perspective or what you guys have been seeing doing deals. On the retail side, Joel, are there creative solutions that owners are offering for tenants? I know we had touched on the percentage rent, but anything else owners are offering?
Yeah, that's I'm happy to I will give you a sort of brief summary, but understand that, you know, I probably spend 10 to 15 hours a week exploring, implementing the answer to this question for 400 tenants. So it's a very multifaceted, extremely complex or simple, but just there's a myriad of options. But generally speaking, there are multiple problems typically to solve. One is timing. Retailers feel that they will get there, but they can't get there now. And so there's a cash issue. Who's going to pay what and when? So there's the chronological deferment issue. Another is, and by the way, I should start by saying what Adam Convisor is completely right. You have to drill down initially. Hopefully you've established and have, and hopefully you've worked on your relationship and done the homework and spent time so there's trust and communication, and you're knowledgeable about their business, and then you can communicate in an open, transparent manner about what their situation truly is. And then starting with that as your foundation, you can start to solve problems. And so the first question is, what is their cash position, and what do they really need, and what are they saying they need? But if you can have an open dialogue and you can discuss what their cash position is, then they have to get through the contractual obligation. And if the retailer wants to be at that site because they believe in that site, then you can start to roll your sleeves up and start to discuss possibilities. One is the deferral of rent. One is the potential abatement of rent. Sometimes we'll trade deferral and or abatement for term extension. Sometimes we'll add credit enhancement with abatement or deferral when you have term extension. Sometimes there can be discussions of physical alterations of the center on a temporary basis to assist them. And they're like, we've put up tents where restaurants have actually brought in a lot of revenue. But that requires getting other tenants to be on board because they might have lease rights about altering the parking field. So most of the conversations revolve around cash management. Some involve working the center to help the tenant to enhance their cash management. There's discussions of the federal aid, the PPP program, and their use of that. There's you try to make it a win-win as much as possible, but there's also the zero-sum dialogue of, you've taken millions of dollars out of the business. This is the best scenario out of the business over the years. Maybe, you should be contributing as well. Retailers don't like to hear that, obviously. And then the fact that retailers are open now has obviously helped the conversation, but it's mostly revolves around cash management and obligations and how to help work together to solve that problem, especially if you believe longer term, if both parties believe longer term in that concept at your site.
Great.
Hey, Elizabeth, if you don't mind, can I jump in here?
Yep, absolutely.
Hey, so I wanted to actually follow up a little with Joel, what you said, and talk a little bit about deferments. The problem with deferments is it terrifies any business owner knowing that they have to pay it back eventually, and their model really doesn't work for that. I'm wondering what you're seeing, what you're kind of offering, what kind of suggestions you have for tenants who are trying to think about that, and really how we get around it. And I think at the same time, the question for everybody is, what happens if there's another wave, another shutdown in the fall? Is that sort of the end game for a lot of tenants? And really, what does that do? What does another shutdown do for us?
You want me to, yeah. Well, you asked two different questions that are both good questions. The first is, how does a model support deferring an obligation, which I think is a great question. And then a second is, what happens if there's another shock or another negative? The deferral part, I think, is part of the overall sort of, I'll call it a holistic discussion of what a business can afford. And, one could theoretically defer it over as long as you want. I mean, if there's let's say that a tenant has 6 months left in this term and you believe in the concept and you extend them 5 years, and then, you defer interest-free 6 months of obligation over 24 months, that feels manageable, right? If they're making money, if you believe in the concept, they should be able to pay that. That's a better example, but so I think different models can afford different levels of strain over different periods of time would be one answer, Greg. The question about future shocks is one that concerns me. I think that a lot of retailers are strained right now. I mean, I'm very sympathetic to, we half of our retailers are mom and pops. And I am personally very sympathetic to their plight because, one, I think that that's their life. We all know that, and I take that very seriously. But two, that's what I grew up with. My dad owned a drugstore. I worked in my dad's drugstore, from a young age. I mean, he had me cleaning bathrooms when I was 10. So, like I really, and I saw his migraines literally that he got. So I have a lot of sympathy for small mom and pop retailers and the challenges they face. And I think that that enters into my dialogue. I mean, it's back to what Adam Conviser said. You need, as a landlord, to really drill down on the relationship and understand the plight of the individual. And I think there's room for good business practices with compassion and communication and understanding. So, Greg, I would say that a second shock is going to hurt a lot of people. But the question you have to ask yourself is, let's say you have a hair salon and there's another shock and they can't pay again for 6 months. What's your next best alternative? I mean, if they're a good operator, then you're just going to find another operator who maybe is equal or less competent. So why wouldn't you take their bird in hand if you believe in them as an operator? So at the end of the day, I think that if you think you have a good operator and you think the business model makes sense at that site, you're motivated to work with them. Whatever that means and what the situation specific is another matter. Every situation is very different, but I don't know, that's one answer.
It also depends on the flexibility of the landlord and what their basis is in the property. I mean, you've got more wiggle room if you've got more margin, obviously. So there are a lot of landlords that bought things over the last few years that are constrained by, they've got a mortgage and they bought it at a certain cap rate and a certain return. They just don't have any wiggle room. And then I know a lot of mom and pop landlords that are generational owners and they don't have a basis on it. And those seem to be the ones, for the most part anyways, where I've seen them say, we're going to give you 6 months off, or we're going to completely work it, or we're going to roll back the rents for the next 5 years. So I think everyone is coming up with different solutions, and those solutions are based on your predicament and what the predicament is. And then also remember, a lot of landlords, it's not just the big bad landlord, they're held hostage by their lenders, and they can't make changes to leases without their lenders involved. So I think that's another thing that's handcuffing a lot of people. And another shutdown will be a continuation of what's going on. I mean, we'll see a thinning of the herd. We're already seeing it. A lot of people are not going to reopen. And there are some that are going to take advantage, right? There are a lot of restaurateurs that are well capitalized, that are nimble, that are changing their concept, redesigning their stores. They're going to come out of this and be stronger. So there will be people that actually come out of this and are going to be very well positioned because there won't be as much competition. They've restructured their businesses. They built the model for the future. And so I think a lot of innovation is going to happen out of this, right? Municipalities are doing a lot of things with regard to, I think Needham just reduced their liquor license costs. You see a lot of help all the way through. Outdoor seating, changing in zoning. I think someone asked a question about what can these municipalities do. We need more densities in the downtowns. The downtown Needham needs more density. It would support all of the retail that's there. That's a zoning thing. So I think it's about everyone having these dialogues and all being in it together. And I think that's happening. We see these communities coming together, but it takes time. But another shutdown would absolutely be devastating in the retail. In my mind, it would be devastating.
I do think, Adam, your point about municipalities is a great one, because I think that the market got so hot and municipalities became, very inflexible and a little bit overreaching. And I already see municipalities who are scared, rightfully so, about their downtowns. And we are seeing preliminary signs of more flexibility to work with landlords to sustain or create vibrancy. So I think that's going to happen more, and it's overdue.
So that brings up a question that we had from what submitted questions. You each work in different municipalities. What kinds of things could cities and towns do to make this environment easier now? Where have you seen somebody do a good thing or a smart thing, and really what kinds of things could be done?
Some of the stuff maybe can't be done, but you look at like taxes. Taxes have gone through the roof, and it's like another rent. In Brookline, the real estate taxes on retail and Coolidge Corner are, $12 to $14 per square foot. That's a rent line item. And so I don't know if they can do anything about that, deferring it, abating it. But at the end of the day, to the tenant, the rent and the taxes and the triple nets are all one number. It doesn't matter who you're paying, it's one number. So I guess if you could have flexibility on the taxes, that would be one. More density in these downtowns would spread the taxes out potentially. Maybe you can lower the tax base on the ground level if you can spread it out over a larger building. So I think the densities would help that. And these are complex problems, but making it easier to get liquor licenses, these capping on liquor licenses and selling them on the open market. It's some of these licenses have gotten in Boston, $450,000 for a license. That's not sustainable. You can't support a business doing that. So I think there's a lot of dialogue around licensing, around outdoor seating, around easing the parking restrictions. Those are types of things that would help, but there's lots of things municipalities can do, but at some point their hands are tied too, right? They've got budget constraints.
Great. Awesome. Thank you, everyone. So we're going to jump into question and answers. If anyone else has any, please feel free to throw them in the Q&A section. One that did come up for both Adam Convisor, Joel, is there a reasonable percentage rent for a restaurant? What would you suggest?
That's a hot potato.
Restaurants have different formats, have different profit. A lot of people refer to it as an occupancy cost, right? Which is just obviously your gross rent divided by your total sales volume. And that's a common sort of metric that retail people use. And so that's, I think, what you're referring to. And different restaurants have different levels of profit. Liquor has traditionally played a big role in restaurants' ability to pay more rent and a higher occupancy cost. But generally speaking, for sit-down restaurants, you hear a 6 to 8% occupancy cost as being an acceptable, sustainable model. I think that for higher margin businesses, like coffee or certain fast casuals, you can go as high as 10 to 12%. I think a Starbucks model is probably a higher occupancy cost than a sit-down restaurant model. But a rule of thumb, just generically, I would say for a sit-down restaurant, probably 6 to 8%. I don't know, Adam, what do you think?
Joel, this is being recorded. Yeah, I mean, I agree.
My center, and then I need 15. But I
generally agree with that. But Starbucks may call you later, so. I generally agree with that. I mean, but the liquor is a huge thing, and the question is, are these when are you going to be able to go back into a restaurant and sit at a bar? I mean, that's not coming anytime soon.
There are restaurants that have 75% of their sales are liquor, and the markup on liquor is so much higher than food. If the food markup is 10-15%, liquor can be 100% or 200%. So if you lose the bar and you lose the density of liquor, then your model is just completely different, right? So
I think Golden Temple in Brookline is delivering Mai Tais.
Or they wish they could, that's for sure. So.
All right, and then with 5 minutes left, we've got a couple other questions. One of them relating to it's kind of the sublease space and if we're seeing more of it, but kind of adding that question, Adam Meixner, with the sublease space, which I think is going to be part of your answer, but a lot of the companies we're talking to, our clients, are saying, well, the office market rents must be going down, owners must be struggling. What are you seeing? Are there going to be big discounts for office space, and how does sublease space play into that?
Yeah, I mean, it's like I mentioned before, you've seen a lot more space come on the sublease market downtown. And from what I've been hearing, it's not so much because they have to get out, of their lease basically, but it's kind of like, hey, the work from home is working for us now. If we can sublease it, great. If not, then so be it. I mean, out in the burbs, there's been far less subleases that have come to the market. And from, my experience over the last 2 to, we'll call it 2 months, really, it doesn't seem like the landlords out in the suburbs are concerned, because, I mean, tour volume has been way up since June 1st. Number of deals have been signed, and, a lot of these tenants are need to do something and aren't just closing up their office and everything. And then, we haven't had a ton of tours from downtown tenants. Although, like I said before, the brokers are starting to inquire about the spaces. So, over the last couple of decades, a lot of tenants have been shifting towards moving downtown. And we're seeing that and expecting that, rather, I should say, to be the opposite over the next, 6 to 12 months, let's say. So, deals are getting done, and I haven't seen any reduction in rents in the, Newton, Needham, Waltham market. I mean, maybe, improvement dollars are increasing a little bit from the landlords in an effort to get the deals done, but it doesn't seem like there's been any changes in rent or free rent for that matter. I mean, they were being pretty aggressive before, and I think that was, working for them. So.
Great. One other question from the audience, could international developments, for example, reverse outsourcing, affect types of commercial real estate in our area? This probably falls more in like a flex manufacturing type question, if I'm understanding it correctly, but anyone have comments on that?
The one thing I'll comment on, sort of last mile and delivery on retail, we're starting to see some tenants looking for retail spaces that have larger distribution as part of the space, because they're going to be doing some distribution and also wanting flex in that space during times of the year where the retail sales floor may expand and the flex space may shrink, and then other times of the year where that flex space, but they're wanting to do distribution. So that's something that I've been hearing about for the last couple months, and have a couple of tenants been inquiring about it. So that's interesting. I have not seen that before, but a different hybrid of space.
I mean, the flex industrial market has definitely been hot for the last couple of years, and it continues to be. I mean, it's, if you think about it, you're not having employees sitting, shoulder to shoulder in an office. I mean, there's giant warehouses where everything's spread out and everything. And I mean, in our particular market, the Newton Needham market, let's say, a lot of those flex buildings have been converted to buildings such as TripAdvisor, let's say, into office space. So there's far less supply in this area. So therefore demand's gone up and pricing's gone up. So, and I think you'll continue to see that, for the next several years as well in Eastern Mass.
Great. The only other thing I'd add from our research and things that we've been talking about, things that are more bio, life science, manufacturing, we're seeing some groups interested in grabbing more space or, clustering closer together and bringing some of their manufacturing closer. But for anything that's kind of bigger warehouse space, they're still going to be looking, if they are bringing it back from international spaces, they're probably going to be looking more in cheaper areas to do big box spaces and manufacturing, where the labor here is just too expensive to bring it specifically to the area. But as Adam Convisor mentioned, that the kind of last mile, things like that, is still really hot in this area. And Amazon obviously is a big player in that as well. So industrial market's definitely hot and kind of still moving at normal pace, to be honest, or if not more, a higher pace.
You're going to see more. You're going to see more direct consumer brands that now will jump into the brick and mortar game, seeing an opportunity, also become part of that last mile component.
Great. And then last question, because I know we're right at 11 and don't want to keep people too long. Any insights on if sale prices have changed, stayed the same, gone up? Any insight on that?
Rental rates, you mean?
So sale prices, so price per square foot is there. Yep.
I think it's too early. I
mean, the investment sales market has been, in my mind, very static. We actually had a couple of deals that we were getting close to, and then we paused because Adam's 100% right. You don't know what the new price point level will be. You don't know whether a market's going to build in 100 basis points of risk, or you just don't know. And so you don't know what's temporary and permanent. And, you could take a position now, but my guess is that, it's most people don't want to commit in this market until they know a little bit more. It would take a lot of guts to jump in today with so much volatility. Is sort of my answer.
Yeah, I mean, go ahead, Adam.
No, I'll say.
Yeah, I mean, we do a lot of like user sales, investment sales in the area here. And we're not sure exactly where, where pricing is going to land on a lot of these assets, although it seems like confidence has certainly increased over the last 60 days or so. So we're seeing more of these sellers comfortable with bringing the properties to the market to see, what they can get. And, a lot of the user sales for the last, 10 plus years, I feel like we're getting a call a day about someone that wants to buy their own office building, and that really quieted down for a while. And it's still relatively quiet compared to just leasing, but I think there's still enough, out there where people are comfortable with their business. And let's say it's a law firm, right, that has all hardball private offices, and they want their attorneys to be there and everything. I mean, there's a few of those groups looking around right now. So, but it'll be interesting to see where it goes. And rates are certainly low right now, which helps. So.
Awesome. Well, thank you, panelists, for taking the time. We really appreciate it. If anyone has questions, I'm sure all of you are happy to, take emails after the fact. So Craig can give correct contact info. I know Adam Meixner, someone had asked about the article that you had mentioned. So maybe we can pass that around when we send out the recording of the webinar. So with that, I'll turn it back over to Greg, and thank you everyone for taking the time.
Great, thank you. Thanks, Elizabeth, for organizing this, and Adam, and Joel for the great conversation. Really appreciate it. Everybody have a great day, and there is a quick survey before you sign off. You can give us some feedback if you have other topics you want to make sure we get to. Thanks to Direct Federal for sponsoring, and have a good one, folks. See you later.
Thanks.
Thanks, everyone.